My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now.
Hey, I'm Cramer. Welcome to Mad Money. Welcome to Cramerica. I'll be one of my friends. I'm just trying to make you money. My job is not just to entertain, but to educate and teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. The bull is dead. Long live the bull. And that's been running through my head ever since we started learning more about what the Federal Reserve has in store for us. To me, this market is pivoting, and we need to pivot with it. No, you will pivot with it even if you have to be dragged kicking and screaming doing so. That includes the daily today, where the averages start off ugly, then recovered. Dow finishing up 87 points, S&P advancing 0.43%, NASDAQ inching up 0.06%. And this was actually a very pivotal day. You know, when I was a hack journalist, writing 3 stories daily about homicide, devouring all the Dashiell Hammett, Raymond Chandler, James M. Cain I could get my hands on, I always had in the back of my mind that you had to slaughter your pearls. Those phrases that you thought were so ironic, so bold, so brilliant that you put in your articles. Those were the ones that had to cut, even if they felt like your best work. Kill your darlings. Kill your darlings is writing 101. I bring this up because when you get a pivot in the stock market, a real sea change like we're having right now, it's tough to slaughter your pearls, to take what brought you to these exalted levels and realize they aren't getting you anything. They're not going higher. If anything, it might be what drags your portfolio much lower. You see, when the Fed decides to raise interest rates aggressively to stop inflation, 2 things happen. First, whatever was working can't continue to work as well. And second, whatever isn't working can get a new lease on life. So let's take 2 real-life examples, because I think this explains what you see is what the future is. We're going to do Amazon and Eli Lilly. Amazon is the cornerstone of FANG, the bellwether tech stock of our generation. We bought a ton of Amazon for the charitable trust when President Trump decided it was getting the better of the post office back in 2018. Since then, we have a double. Nice. Recently, Amazon reported one of the best quarters I've ever seen. And what the stock did, well, it ran up a tad, but it's been giving it up ever since. And the stock's now down more than 5% for the year. It's a huge disappointment because it's already reported an amazing quarter, and the market couldn't have cared less. Do you think next time's amazing quarter will be any different? No way. You always must pay attention to what happens to a stock after a great quarter. If the answer is nothing good, then it might be the last great quarter. Meanwhile, Amazon stock sells an extremely high price-to-earnings multiple. It's got a really lofty $1.6 trillion valuation, huge amount of money. When the Fed decides to kill off an inflationary spiral with higher rates, you're not supposed to buy expensive growth stocks. The hedge fund playbook says that you should sell stocks like Amazon until the tightening cycle is nearly over. Very hard to fight against that, even for this Amazon lover. Now let's consider Eli Lilly. This is a huge position for our charitable trust, which, let's be clear, has moved to CNBC from the old website I started. Lilly's up huge for the trust. Why? Because when the Fed starts hitting the brakes on the economy, money managers circle the wagons around recession-proof stocks, including Big Pharma. I can tell you that Lilly's doing well because of its diabetes/weight loss drug or its impressive work with the brain to roll back plaque in Alzheimer's patients. But the fact is, we've got a new bull market in recession-proof names that can keep putting up good numbers even in the face of a slowdown. And Lilly is a prime example of what is working in this market. There are a lot more Lillys than there are FANGs. There's nothing great, by the way, happening at Bristol Myers or Merck or even Abbott Labs, which the trust just sold, sadly. But they're all being reevaluated upward because they're from the very big cohort that wins when the Fed is tightening. It's not just pharma. Take a look at the food stocks. We keep hearing about food inflation, packaging inflation, freight inflation, that they're killing their bottom lines. Conagra just reported a name. Normally would have sent the stock down 5%, right? Well, what happens? The stock actually goes higher. That's investors betting that Conagra is slowdown-proof and inflation is running its course. Call it the last inflation-addled quarter or the last bad quarter. We've seen the same thing happen with General Mills. Wow, what a monster that's been. J.M. Smucker, wish I were on that one. They've been horses, even though the businesses are just okay, and the raw costs, they're obviously bad. When you go out with stock people, invariably they'll say, hey, is this the time to buy Church & Dwight? That was a fantastic growth stock that's been just stopped in its track for years. Well, guess what? Take a look at that one. Packaging, freight costs and all going higher. What has to happen here? I'm adamant that you need to be very conservative with the FANG names and their ilk. I said that the other day with David Faber, and David interpreted, and I understand that as saying that I don't like the market. No, unfortunately, I created this, okay? So it's very, very tough for me to say, you know what? It doesn't work in this environment. But we haven't had this environment in a very long time. As I told investors on our wild, self-flagellatory, crazy investing club call, that you really just sign up to listen, and it's going to knock your socks off. Of all these growth names, the only two that I put fresh money into, the only two, I bet you can't guess. Alphabet and Meta. That's because they're not expensive on next year's earnings, especially when you back out the $140 billion on Alphabet's balance sheet. There's no greater return on investment for a small business owner, by the way, than search ads on Google, because Google can tell you how many people came exactly from where to your store. Believe me, if you type best Mexican in Brooklyn, you're invariably going to go led to Bar San Miguel. And Google can prove they're responsible for the traffic by showing you where the query was asked and then by following the queried blue line to you. Ka-ching! Who else knows what advertising's worth? No one knows. This one tells you. As for Facebook, all I can say is, have you looked at Reels lately? You know, the one that's the second-rate one versus TikTok. I think it'll end up being better and more popular than TikTok because Mark Zuckerberg is working on it personally to make that happen. Although I say that as someone with zero understanding of the medium. I have a great understanding of Facebook, though, and their ability to copycat is second to none. All right, now pivots don't happen on a dime, even if it feels that way. This one's very hard because for a long time, the whole stock market bowed to FANG and Friends. It was a bull market in a handful of stocks, a bear market in hundreds, if not thousands of others. Now the bear is changing to a bull, and most of that will happen over the course of the next month. The moves like the one in Target today, an essential merchant with great sales, are initially outsized, but they'll keep going now that the Fed is on the warpath. And by the way, just to touch, I could put up, all the popular semis are the same. They all look the same. They are the same. When you look at the big gains, though, in the drug stocks, you may think you've missed the pivot. Not at all. The oils, they're fantastic. Anything healthcare, just getting started. The utilities, insane, maybe hold off for a while. Fast foods, dynamite, and then battleground of retail, going to be won by the bulls. Here's the toughest one, the financials. It's nice to have a market led by Costco and United Health. But if you're like me, you need to see a giant stepping stone to prove the validity of this bull market. And in order for that to happen, we need to see the banks rally when they report. The Federal Reserve is raising short-term interest rates, which instantly makes the banks more profitable. They should benefit substantially, just like they did in the, remember that 1990, 1992 period? Of course, nobody does except for me. Mostly because Alan Greenspan was worried about the financials, wanted to make them make easier money. That's what's going to happen again. Why aren't people focused on that? Because they were in diapers or feet pajamas or something? The bottom line, if we get the financials going here, the healthcare, more retailers, even if we lose the trillionaire stocks, which would be sad, we'll have a much healthier bull market than we have had in many years past. I need to go to David in New York. David.
Thank you, Jim. Booyah.
Booyah.
Thanks for taking my call.
Of course.
A fan of your show and appreciate all that you do for us investors.
Oh, thank you. I hope you should join the club, man. We did some kind of a real teaching session today like you've never seen in your whole life. What's up?
Fantastic. I'd like to get your perspective on Starbucks. I'm a significant investor. The stock has come under a lot of pressure here, down over 25% year to date. And there's quite a few moving pieces here heading up into the earnings call April 27th. I really like the brand and the product. I think they have some pricing power left still in this context of the inflationary environment, but they have some headwinds. Unionization risk started in Buffalo. Now it's going across the stores. Schultz stepped back in as the CEO and announced suspension of the share buyback to focus on investments in people and stores, but they have a large debt load. And we're seeing increasing pressure from Dutch Bros as competition may be heating up. So I'd love to get your take.
All right, Howard Schultz is there. I am a huge believer in Howard Schultz. I think he will figure out who should run the company. In the next 5 months will be a learning lesson for everyone watching how to make it so this company reignites even with high inflation, even with China lockdown, even with union issues, because that's what Howard will do. In Howard, I do trust. And by the way, I told Howard about the Annihilator and Dutch Bros a long time ago, but you know what? It takes two to tango. When the Fed decides to tighten, whatever was working can't continue to work as well. And whatever isn't working, well, gets a new lease on life. And that's what's happening now. But get this. If we get the financials to go along with the healthcare and the retail move, even if we lose the $1 trillion bull market, we will have a much wider, broader, healthier bull market than we've had in years. Man, tonight, are you getting the Best Buy in Best Buy at 8 times earnings? Shares down over 10% over the past month. Good dividend. I got a chance to sit down with the CEO at the company's Midtown Manhattan stores. They make things, sell things at a profit, give money back to shareholders. Last time I looked, that was good. Then with the Masters underway and the Masters and Tiger Woods on the course, could an investment in golf be a hole-in-one for your portfolio? I'm hitting the links to find out, and I've got the green jacket that's deserving. Hey, by the way, what's eating at ConAgra after earnings? I'm sitting down with the CEO to find out how the company's positioning itself in a volatile market. Masters, ConAgra, always in the same sentence. Stay with Cramer.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.
Shepard Smith here. Thanks for watching CNBC on YouTube.